So on this video, we're going to talk about some of the potential techniques that high net worth individuals can use to save money on estate tax. Right now, the estate tax exemption is a little over $13 million, which means that you can either give away or die and give away $13 million during your life, and your family or your estate won't incur any estate tax. Now, if your net worth greatly exceeds that amount, then you may want to consider doing some tax planning to reduce your gross taxable estate so your family saves, maybe millions of dollars in estate tax. In order to do that, though, you need to do planning during your lifetime. And some of the techniques involve irrevocable trusts. It could involve family limited partnerships. It could involve irrevocable life insurance trusts. In short, there's a whole number of techniques that are out there that you could utilize to save your family estate tax. And if you have any questions on that, we're happy to sit down and meet with you and go over some of the potential techniques that you could utilize to save your family money. One of the questions we get a lot from professionals, doctors, lawyers, accountants, engineers, is why should they form an LLC if they are providing a professional service? And there are certain income tax benefits that these professionals can utilize, which allows each one of them to save money in self-employment taxes. So if you're getting a 1099, for example, and you have to report that as self-employment income on your tax return, on your 1040 tax return. Now, what you could do to save money in self-employment taxes is form an LLC, have it elect to be treated as an S corporation for federal income tax purposes. Then what you would do is pay yourself a W-2, a salary from that LLC, and you try to keep that salary as low as possible. And then any earnings above and beyond that salary would be entitled to take a dividend or a distribution, which wouldn't be subject to self-employment tax. Now, keep in mind, the salary still has to be reasonable because you do face a potential IRS audit if you're just paying yourself $1 and then everything else you're taking as a dividend. That won't fly with the IRS. But what that ultimately saves you is money in self-employment tax, because if you didn't form the LLC and elect for it to be treated as an S corporation, then everything gets reported on Schedule C of your 1040 and would be subject to self-employment tax. So that's a common tax planning, income tax planning strategy that some of our professional clients use to save self-employment tax. A family limited partnership can be used to transfer value out of the estate of a wealthy individual. So in creating a family limited partnership, it involves creating an LLC, which would act as the general partner. The general partner has total control over the partnership assets. So the general partner is the equivalent of the manager. They're going to manage the assets for the limited partnership. And it's important to form an LLC to do that, or a corporation, because the general partner of a limited partnership has joint and several liability for the activities of the partnership. So if an individual is a general partner, personal assets are at risk. So that's why it's important to create a separate legal entity to act as the general partner. Then the limited partners would typically be irrevocable trusts that are the beneficiaries of the client's estate. With those irrevocable trusts, they would hold the limited partnership interests in that family limited partnership. And then there's all sorts of mechanisms that people can use to discount the value of those limited partnerships And the purpose behind this is to reduce the value of the client's taxable estate. So by funding that limited partnership with a portion of your assets, you're transferring value out of your estate into that limited partnership, which is ultimately going to go to your children in those irrevocable trusts. So that could potentially save you money in estate taxes when you die, because you've now transferred ownership of everything from you into that limited partnership. But at the same time, you've also still maintained control through the general partner that you've created to run the limited partnership. A life insurance trust is a special type of trust to prevent your life insurance policy from being subject to estate tax upon your death. The general rule is that the owner of a life insurance policy, the proceeds of that policy when the owner dies, gets included in the gross estate of the policy owner. Now, that result can be avoided if the policy owner creates a special trust called an irrevocable life insurance trust, or otherwise known as an ILIT. So what would happen is that ILIT would own the life insurance policy, and the insured would still be the client, so you would still be the insured. Now, when you die, those life insurance proceeds get paid into that ILIT, and therefore is not subject to estate tax. So it keeps the life insurance proceeds not subject to estate tax. Now, for most people, this isn't an issue because they don't have a taxable estate. If your estate is taxable, then you need to consider setting up an ILIT to avoid this result. And the current estate tax exemption is a little over $13 million, and life insurance is included as an asset in making that determination of the value of your gross estate. If you're a high net worth individual and you have an advanced estate tax planning problem that you need help or consultation with, feel free to give us a call, and we're happy to sit down with you and answer any questions that you have.